Today I have a very special video for you, and we're going to take a look at a complete trading strategy. We're going to focus on fake outs, liquidity runs, stop runs, what are momentum drives, how to get into the best trades, and what to look for in the perfect chart. And now let's get into it. From my experience, I know that a lot of traders are struggling with fake outs and failed breakouts. And yes, they do happen quite a lot. And the good news is that we can use them to our advantage and find trading opportunities with them. So when we look at this chart, when you see something like that, that should catch your eyes because that's a huge pain point for a lot of traders. For breakout traders who were long, they will be sitting now on a loss as they took the breakout above the resistance, above the moving average. Their stop will be somewhere around here, down here, somewhere in this range, and they will be sitting on a loss or even get a stop trigger. Traders who have been maybe short initially, maybe after the breakout through the last swing low, are also getting squeezed up here. Where will you have your stop loss if you get in short here? It will be somewhere above here. Maybe they use a trailing stop loss around the moving average. And so the long and the short side both will get squeezed on this. And those are great starting points for an opportunity. How do we know this is true? When we go to the lower time frame, now we can see there's a lot of momentum drive coming in. You can see the market broke this level very strongly, and then you can see as it came back into the range, the price really accelerated to the downside. What does this tell us? It tells us that there's a lot of liquidity that is freed up. If you get in long here, your stop loss will be down here. And as the stops get hit, the speed of the price movement will increase significantly. So this is a very important market tell. If you see that after a breakout, when the market seems to be failing, the momentum increases, this is a very important thing to note on your chart. Now let's skip ahead a little bit and let's see what happens afterwards. This is the big fake out where the price accelerated. We have a continuation pattern, which is a very important market tell. It shows us that from left shoulder to head to right shoulder, the market was not able to continue higher. The price is not even able to come close to the previous highs. From the head to the right shoulder, the market made lower highs, stayed below this moving average, which is also a key factor. And then as the price broke out through the pattern, it started to accelerate once again. We are seeing momentum kick in. The speed of the price is really accelerating. And that's something that is always important to note on your chart. Is the price accelerating? Is it accelerating where it actually does make sense? It does make sense to see price accelerate here as the stops are getting hit and as the people are getting squeezed. It does make sense to see the price accelerate here. We are trading below the big range. We're trading below the continuation pattern. Also, let's recap. If there are breakout traders long here, there will be some traders who have stops here. There will be also traders who have to stop below the low. And now as the market breaks through the ultimate low, now even more stops are getting hit and you can see the price accelerate. So this is the perfect entry signal here. And you can see the market kept accelerating as more buyers were stopped out and as more sellers got into the market. This really leads to those momentum drives, and there's a very important pattern to note on your chart. This pattern is very common in the markets, and you can also see it in a trend following context. So here in this chart, we are in a downtrend. You can see I'm using the 50 SMA, and the price keeps trading below the moving average. And this is a very common pattern. You can see the market established a support level, broke below it, came back into it to retest it, but not only retest the lows, also retest the moving average. And we're getting a lot of fake out volatility. Now let's get to the lower time frame. We want to look for shorts into the big picture direction. This is how it looks on the lower time frame. You can see we have a very nice triple top. We're seeing here, this is where the momentum kicked in, where we had a failed breakout. The market is trading back in the range. However, we need to wait for the market to break out of this distribution area. As long as the market is trading inside of such a range, it could go either way. It could go up, it could go down. So we need to wait for an impulse. And you can see this is what happened afterwards. The market really broke out. We have the initial flush of the momentum. If you don't catch the first wave, that's totally fine. No need to rush, no need to hurry. Just wait for the consolidation here. That's where the pause drive is. So if you see that there is a huge momentum flush, this tells us that the market is resuming into the big picture trend direction. So it's a good sign that if you want to be short, don't chase the price, wait for the consolidation, then you can get in on the next leg. So we have the drive, pause, and drive pattern. So we are trading into the higher time frame direction. which is short as we have seen here. We're trading at the perfect confluence area, moving average with the support and resistance zone. We're waiting for the distribution to end, and we're getting in on the next drive. We have the confirmation of the first drive. We're not getting in on the pause, on the consolidation, and then you can see the market in a short period of time really moved lower a lot. Let me show you a different entry trick, and we are looking at a different chart on the higher time frame. And we are trading right at this previous support area, which seems to be becoming resistance. There's also this moving average, which is very important. It's the 50 SMA. And now let's go to the lower time frame. We want to probably look for short opportunities as we expect this level to hold. We don't know yet, but let's see what we have on the lower time frame. Here we can see the triple tap. I made some videos about the triple tap. In my opinion, it's one of the most important patterns that you can learn. It shows you an exhaustion pattern. It's also a divergence pattern. And this shows you that the market is exhausting. In this long uptrend, probably a lot of traders are taking profits. There's also probably a lot of traders who have been waiting to sell this level. And this is what happens here at this area. Another very important thing that is happening here is that the momentum and the volatility increases. Very often at turning points, such as here, the volatility increases. This is where a lot of traders run into problems because waiting for the best trade is obviously very hard, as you may know if you have been trading for a while, and then they will get chopped up in the range because they cannot wait. However, the real trading opportunity exists a little bit later. Once the market leaves those volatility zones, such as here, you can see the candle size is increasing, but also the volatility, the wick size is increasing a lot. So there's a lot of chop, there's a lot of back and forth. And this is very common for turning points. We know that we want to be probably short, but we don't want to be short just yet. We don't want to get into this chop because that's how you're going to lose a lot of money. We want the market to clear this area. We want to see that the market is exiting out of the volatility zone. And it did so after a while here. You can see this is the volatility zone. There's a lot of back and forth. There's no money to be made here. But if you can practice the skill of learning to sit on your hands, be patient, wait for the trade that occurs a little bit later, then you may increase your win rate and your profitability quite a lot. You trade into the direction of the higher time frame, you have your clues from the lower time frame, we have the triple tap, we have the momentum increasing, we have the volatility increasing, we have the breakout, we are trading on the right side of the moving average, and then you're trading with a high conviction rate. Now let's look at a more advanced example, and we're going to learn more about momentum drives and lower time frame liquidity. We're starting our analysis on the higher time frame. Clearly the market is short. Clearly the market is in a downtrend. We are trading below the moving average. The market is making lower lows and lower highs. I turned on the weekly pivot point. This is the central weekly pivot point, and the market keeps trading below it or around it. And this is a very good sign. We are in a short market, so we want to look for shorts. On the lower time frame, we want to look for pain points. So at this point, how does it look on the lower time frame? And what is this candle here telling us? This is a very important candlestick. This is the big candlestick we saw on the higher time frame. And obviously, it's also huge on the lower time frame. And what does it tell us? Remember, we are in a downtrend. Most market participants are short. And probably as the market has been going on for a while, a lot of traders are maybe seeing this double bottom. Then maybe some people get worried, they exit their trades. Probably also most of the weak hands are exiting their trades, which is retail traders, impatient traders. And yes, you can see it leads to a big jump, but in the bigger picture, it's just one candlestick. It's not really a lot. It's not enough at all to change the direction. We are rejecting the pip, we are rejecting the previous low, and also the moving average. So yes, there's a lot of momentum coming in. And if you don't look at the bigger picture, this may scare you out, but it's just one candle. Probably a few traders are exiting their shorts to bank in some profits, but the market, after trying to break out, immediately reversed back into the range. So we are in a downtrend, thus we never even think about buying, so we're just waiting patiently. And what do we observe a little bit later, after the market keeps trading in the range? We see suddenly an injection of momentum. You can see the market came close back to the previous high, and then as it hit the level, the momentum increased. You can see the candle size suddenly changed quite a bit. And suddenly we have this huge momentum drive that is bringing us all the way out of the range. This is a very important piece of market information because it shows that the sellers have probably woken up. The price rallied higher so that it became more interesting for the sellers again. And then this led to this sequence of selling that brought us all the way below the low. We closed at the lowest point, we closed below the big picture range. And that is then a good sign. If you are short, that you are probably don't have much to worry. Of course, things can always change, but this really puts the odds in your favor. And if we skip ahead, you can see this is where we have the breakout. The market stayed below it and kept trading lower. So we continued the big picture downtrend as the market kept rejecting everything as resistance. All resistance levels always held. The pivots, the moving average, the previous high and low structure. We even have a fake out where we have a failed breakout attempt that was rejected. Those are all very, very bearish things. And it's important that you understand what are bearish, what are bullish signs, so that you can trade with more confidence and also pick the right direction. And I hope you learned something in this video. Let me know in the comments below if you find those types of trading strategies helpful. Don't forget, there's a new video coming out every Tuesday and every Saturday. And Thursdays, there are new podcast episodes coming out.